All right, hello everyone, and welcome to the business law section of the Florida Bar's Blockchain and Digital Assets CLE series, Tokenizations Explained. My name is Daniel Mayland. I'm a commercial litigator based in Miami, Florida, and I provide commercial litigation outside general counsel services to blockchain, crypto, and Web3 clients throughout the state and the country. I'm also the second vice chair of the Florida Bar Business Law Section's brand new Blockchain and Digital Assets Committee, and welcome all of you to join that if you're curious about this space. I also have the honor of being the chair of the Florida Bar's Blockchain and Digital Assets series, which we are kicking off with today's panel on tokenization. We'll be hosting additional panels throughout the year, each focused on a specific aspect of blockchain and digital assets. So please keep your eyes open for future announcements about our forthcoming panels, the next of which will be in about 2 months' time. Today, to discuss tokens, we have an esteemed panel of experts, all of whom are hands-on working in this space on a daily basis. First, we have Commissioner Russell Weigel, Commissioner of Florida's Office of Financial Regulation. Commissioner Weigel is an AV-rated securities attorney with more than 30 years of legal experience and a published author. In 2005, he founded a securities transactional and litigation law firm, which he ran until he became the Office of Financial Regulation Commissioner in March of 2020. Prior to that, he served for 5 years as a securities transactional litigation attorney and for 10 years as an enforcement attorney with the Securities and Exchange Commission. He holds an undergraduate degree in economics from Vanderbilt University and a Juris Doctor from the University of Miami School of Law. Next, we have Mike Lingle, who is the CFO, Security Token Group. Mike and his team at Security Token Group are focused on the coming wave of digital asset securities and the present wave of digital asset securities as well. Mike also founded Rocket Pro Forma to help startups quickly create financial projections. Mike is a former software developer who's raised venture capital, launched more than one presentation company, had an exit, and run several startup accelerator programs, and also currently serves as an entrepreneur in residence at Founder Institute. Also here is Paul DeCoste, who spent 5 years working in the blockchain and cryptocurrency space, having worked with attorneys, developers, and founders before deciding to become a lawyer. In 2017, he founded a blockchain startup, which he managed until 2021, when he moved to Florida for law school. At FSU Law, he is a member of the Moot Court team, an editor of the Business Law Review Journal, and currently works as a law clerk focusing on securities regulation at the Office of Financial Regulation. Paul also volunteers for the Blockchain and Cryptocurrency Task Force and has been instrumental in helping put together the CLE series. Finally, with Thomas Shivers, the co-founder and chief investment officer of Kingsley Capital. Thomas has been active in the blockchain and cryptocurrency space since 2013. His initial focus as a trader opened opportunities for him to get involved with new protocols and advise their tokenomic model. Thomas has held more than 40 advisory roles and actively holds more than 10. In 2017, he co-founded one of the largest cryptocurrency conferences by attendance, which opened another door for Thomas to become an angel investor. He has invested in more than 20 seed stage companies and actively looks for deals to participate in. In early 2019, he co-founded Kingsley Capital Management, a registered investment advisory with a focus on the digital asset space. Kingsley just launched its first flagship fund in February of 2022. So today's panel is going to specifically focus on tokens, which are a product of blockchain technology. Tokens, more than nearly any other aspect of blockchain technology, have captured the world's attention. When you see the news talking about blockchain, it's usually talking about tokens. When you hear about NFTs, crypto rewards, decentralized finance, or DeFi, these are all hot terms that generally refer to tokens. For those of you who are looking for a primer on blockchain in general, and who the words that I just said went right over your heads, it's okay. I recommend you hang with us. It's going to be fine. I guarantee you'll be able to understand this and you'll learn something. And during another lunch break, I recommend you check out the Florida Bar's CLE course number 5776, Blockchain and Tokenization Made Simple, which can be found on the Business Law Section's YouTube channel. You can just Google Blockchain and Tokenization Made Simple CLE. What's cool is that for, I believe, the next year, if you watch that YouTube, you'll get the CLE code from that YouTube and that will still count for a CLE credit with the Florida bar. You can enter that online. If you have questions, please put your questions in the Q&A box that you see on the screen before you, and we'll do our best to get to those during the course of the conversation and at the end if we have time. This is only an hour, and so we're going to do our best to get to the questions when we can. Before we get started, I would like to thank you all again for being a part of this. To the extent that you have input on how we could do this better, considering this is the first of what will be hopefully a series, you're also welcome to put that into the Q&A section, and we look forward to your feedback on that. So with that, I'm hoping that Mike, you could kick things off by walking us through the easy topic of what tokens are and just summing up $1 trillion industry in a couple minutes for us. And I hope you can do that now.
Sure. All right. So my name is Mike Lingle. I'm from the Security Token Group. And basically, the most important thing I'm going to say here is blockchain does not necessarily equal crypto. I'll come back to that in a second. But normally when I say blockchain, everyone hears crypto, and that's not true. I will start with crypto. Basically, Bitcoin was invented as a way to create digital money. And it's built on a blockchain. It has its own blockchain. Ethereum came along as an innovation that basically took that idea and turned it into programmable money. So Ethereum adds the ability to add instructions, which is fun for lawyers because now you can start to try to put contracts into code, which has a lot of discussion in Ethereum. The key thing for both Bitcoin and Ethereum and a lot of other cryptocurrencies is there is no underlying asset. So if I go onto Coinbase and buy Bitcoin, I'm not buying a share of the Bitcoin Corporation. If I buy an Ethereum token, I'm not buying a share of the Ethereum Corporation. In fact, the creators have gone to extreme lengths to not have a corporation. So there's this concept of decentralization. But there's no underlying asset. When I'm on Coinbase, Coinbase is not a registered exchange with the SEC. They are a marketplace that allows me to buy and sell unregistered securities. It exists in a gray area. A lot of what we see in crypto, which I'll put into its own category, is in a gray area, and people who are lawyers on this call can talk about that gray area better than I can. In the past couple of years, we've seen the innovation of NFTs. NFTs are like baby securities. So if I have a Bitcoin and Dan has a Bitcoin, we can exchange them and it's the same. NFTs add this concept of one owner, one asset. So my Bored Ape NFT is not the same as Dan's Bored Ape NFT. They are different, and we can each prove that we own them. And now we have baby securities. At the moment, the regulation on that is somewhat gray area. Lots of people are doing lots of things with NFTs. The SEC has said they are specifically looking at things like fractionalization, which probably creates a security. Again, when you're trading NFTs, you are not trading on licensed exchanges. They are not registered securities. You are on things like OpenSea, which is basically unregulated. And that brings us to the third category, which is my favorite, which is if we take one more step beyond NFTs and start to have multiple owners, multiple assets, fractionalization, cash flows, we are now saying that we are going to use blockchain to manage registered securities, and we're entering the world of the SEC. The first two places, crypto and NFTs, the regulations are murky. They will get figured out over time. Once we admit we're creating securities and step into the securities world, we are in the domain of the SEC, and now we're back to regulated entities, registered securities. The SEC refers to these as digital asset securities. And essentially what we can do is we can take private assets, wrap them in a token, and then trade them. And where we trade them with a registered broker-dealer on a licensed alternative trading system, or ATS. There is a transfer agent involved. We use blockchain to keep the immutable record. Again, this is not crypto. This is my point that blockchain is not crypto. And we're actually trading securities. There are some benefits to this. One is transparency. It's easier to regulate when we can see what's happening. Two is we have, we're living inside the securities laws. We have a transfer agent, so if things get stolen or hacked, the transfer agent can destroy the stolen tokens and reissue the tokens to the correct owner on the cap table. And then essentially what we're seeing is you can take private deals and tokenize them and trade them on these ATSs, alternative trading systems, as if they were public shares. So we move out of, if Dan and I are both invested, or if I'm invested in the startup and Dan wants to buy my shares, I don't have to go talk to a lawyer. I don't have to get permission from the company. We can just swap the shares. Real estate has been a huge early adopter of this technology, which is amazing because I've never seen real estate be an early adopter of any technology. But essentially they can get liquidity into deals and it solves a bunch of problems in the real estate industry. We're also starting to see some other creative uses of these digital asset securities, such as Securitize, which is one of these broker dealers that runs the ATS and has a transfer agent. They just announced last week that they are tokenizing an LP position in a KKR fund. So instead of having a $5 million
break that down for Mike. Break that down for a second.
Okay. So KKR private equity fund, they create, they bring in accredited investors or qualified investment professionals into their funds. So typically there's $1 million to $5 million minimum buy-in. What Securitize has done is taken an LP position in that fund, which means they own some of the stake, but they also have to put money in order to buy that stake. They put that LP position into a special purpose vehicle. They are tokenizing the special purpose vehicle. And if you're an accredited investor, you can go on securitize.io and you can buy into that LP position, which is a position normal accredited investors would not normally be able to take. That's the primary. Once that is issued, those tokens will trade on their ATS as in a secondary market. So again, if I buy into the primary and I want to sell out and Dan wants to buy into essentially my KKR position, he can just buy my tokens off the exchange. And so again, we've moved from crypto super murky to NFT super murky into the world of securities. And the laws are exceptionally clear and we're in the domain of the SEC. So those are my 3 buckets for you today.
So, and just to be clear, we're not affiliated with anyone other than the business law section, and we're just explaining use cases of how this plays out. And I'd like to, thanks for that breakdown, Mike. And
none of this is investment advice.
None of this is investment. No, that's really important. But it's touchy because what we're talking about at its core is the most used commercial product of blockchain technology or distributed ledger technology. Distributed ledger and blockchain are record keeping systems. But tokens are a byproduct of that, where they're representations of records that are being kept on those record keeping systems. And we could use those in a number of ways, like Mike just explained. And Thomas, as someone who is a chief investment officer of a company that deals with this in the day-to-day, I was hoping that you could walk through how you're using these products in your life and how those are in play.
Sure. Starters, just have to disclose this is obviously not on behalf of Kingsley and it's not financial advice. So at Kingsley, we're a long-only fund. We focus on thesis-driven investing, primarily in the DeFi space, which is a subsection of the token space that Mike sort of just highlighted. DeFi stands for decentralized finance. It is pretty vast, includes things like liquidity pools, DEXs, automated market makers, all sorts of fun things in that topic. And they may sound complicated, but a lot of them are really just innovations on top of existing traditional finance mechanisms. So when you think of an automated market maker, it's similar to the market makers that trade on Wall Street, just happens to be automated. What we can do is fund that automated market maker in the liquidity pool. We can take 50% of each side of a position. And what ends up happening is the people that trade in that liquidity pool create trading fees. There's arbitrage opportunities as a result of it. And that's one of our primary focuses is providing liquidity to assets that, we believe are strong on both sides. So something like ETH and Bitcoin together in a pool, that's one big thing that we focus on. Outside of that, there's a growing narrative which I'm excited to hear some of the lawyers speak about, in DeFi called real yield. And, you know, it sounds funny, but the reason that that's a growing narrative is because the past year or so of DeFi has more or less been Ponzi-nomics, right? You have large inflated supplies that are paying out people for simply owning a token. So if I own token A and I agree to hold token A, sometimes lock token A, they will pay me more token A as a result of it, which creates yield. But it's not representative of any real revenues or profits that this company is making. They're simply just inflating their token, which creates other problems like, you know, supply and demand on secondary market. And so a lot of people got burnt in that space. So as of a few months ago, one of the growing narratives is around, again, this real yield idea, where protocols or companies, if you want to consider them that, will attempt to create real revenues through things like trading fees or swap fees or bridging fees, all sorts of methods, right, of capitalizing in the space. And what they're trying to do then is take those revenues and return them back to their protocol's token holders. Again, that sounds a lot like a security potentially. And, you know, as of now, that's not defined. We're closely coming up on that, but that's another thing that we focus on at Kingsley, is making sure that the companies that, you know, we're investing in have revenues, that their fully diluted valuation is in line with their current existing, you know, traded market cap, et cetera. So.
Thanks for that. And I can't see you, everyone in the crowd, but I know that there's a whole bunch of you scratching your heads right now.
Yeah. Probably
Probably lost in your lunch salad. And so I want to bring you back into this for a second. When we talk about DeFi, decentralized finance, the defining characteristic is exactly what the name implies. There's no centralized core entity at the center of it that governs everything. Instead, it's distributed using this global immutable record-keeping system. And so there's no centralized bank in the DeFi universe. And that's different than our modern contemporary banking system that we all know so well and use on our daily basis. DeFi, a big premise of DeFi is cutting out the middleman, removing that centralized banking apparatus and decentralizing it to achieve these same or new goals. And so that is the space that Thomas plays in, and it's utilizing tokens as a tradable asset in this space, just as we often use other assets, including securities or other financial tools. So this is not the only use case, however, for tokens. There are a whole universe of them. I mean, really, at the end of the day, humanity's proven that imagination is the limit as to what tokens could be used for. And as an entrepreneur in the space before deciding to become a lawyer, Paul, I was hoping that you could get into a little bit more of what tokens are used for outside of the work that Kingsley's doing.
Sure. Yeah. And thank you, Dan and Thomas, for those explanations. Everybody, I'm Paul DeCoste. I think it would be good to kind of segue into this and talk a little bit about DAO governance tokens. So really quick, DAO is spelled DAO, and it stands for Decentralized Autonomous Organization. And it is sort of a subset of DeFi, but also bring in the idea of having some sort of a centralized organization where, and not necessarily a bank or a government, but there is a core, there is a business unit sort of in the middle of this DeFi and crypto tokens. And so DAO governance tokens are a version of utility tokens, which means they are most likely not securities. And a DAO governance token is used to represent ownership in a DAO. So very similar to how you would own a share or a stock in a company. And if you own, a preferred stock, let's say you get certain voting rights within the company. If you own a DAO governance token, you not only is your ownership represented in the DAO, but you also are given certain rights to vote on proposals and changes in the way that the DAO functions. So for instance, this can be anything from deciding like which partnerships do we want the DAO to engage in, and maybe even like budget proposals for certain projects. So within a DAO, you can use your voting tokens to propose, hey, I have this idea. I see, kind of where we're going with this organization. I think we should do this. You use your tokens to submit that vote as a proposal. And then if that proposal gets passed through to a vote of the entire organization, then everybody who owns tokens within the DAO can vote on whether or not that should go forward. So it's just very interesting because it's this way to allow a ton of different people. I mean, there is no sort of limit on the number of people that could be involved in a DAO to vote on the direction of an organization. And that's something that is typically very hard to do. Traditionally, as I'm sure many of you have dealt with, trying to organize a shareholder meeting to make any sort of emergency decisions can be extremely difficult. And this is a way to sort of streamline that process while also, giving everybody pretty valuable rights in the organization. So that is one use case of tokenization there. And like I said, that's more of a utility, right? There is no value attached to your token other than the rights that you have in the organization. So that's one example. And then another one, and we were kind of touched on this a little bit before, I believe Mike was, or Thomas, but crypto rewards have also been pretty popular, and they've been used in sort of two different ways, but they're both kind of come back to brand loyalty / almost marketing. But for example, so you can use tokens as loyalty incentives. And essentially how Thomas was describing with yield, what you do is you reward crypto holders with more of the crypto that they are holding. So it's a way to kind of get more people involved in your crypto and establish that brand loyalty. And this has also been seen in the NFT space, where owners of an NFT, like let's say you own a Bored Ape, you are given exclusive access to variations of that NFT or new NFT releases that the company puts out. So again, this is just sort of loyalty incentives. You can use these tokens to attract new customers and retain your current customers as well, or your brand, I should say. And then I think we should do a little bit more on the NFTs. I feel like this is the most popular sort of use case right now. I'm sure most people have heard the term NFTs before, and Mike gave us a little bit of explanation there of what non-fungible tokens are. And the interesting part is that they're unique. Every NFT that you own is sort of a one of one, and the blockchain is used to present the sort of unique identifier for each NFT so that you're the only person that owns the one that you own. You can't exchange it for the same thing. You got to exchange it for crypto or something like that. And this really is starting to turn into NFTs representing digital assets, but also real world tangible assets like books and artwork. So kind of going back to what we were talking about fractionalizing. So with NFTs, you can take a piece of real estate, you essentially digitize that real estate by putting it through the blockchain, you create an NFT for it. And now you can fractionalize that NFT and allow for hundreds to thousands of different investors to sort of get in on that investment opportunity. So similar to the DAO, it's just a way to efficiently, manage investment opportunities and allow more people to take advantage of stuff like that. And one more, just my favorite example here of NFTs is basketball cards. So now you can get any type of sports cards, not just basketball, but they're digital. And this helps solve some problems. One, same sort of thing with efficiency in the market. If you have a physical basketball card and you want to try and sell it to somebody, you have to go through the whole eBay process, shipping it out, all that kind of stuff. If it's digital, you just exchange right on the platform that you purchased it from. And there is also no problems of sort of degradation or worrying about losing or destroying a card because everything's digital. So that's been very interesting, and not just sports cards as well, but you can apply that to artwork, to digital artwork, to digital books. And I think we're going to continue to see a lot more applications of converting these real world assets into NFTs and kind of opening that space up for a lot more people to take advantage of those opportunities. So that's kind of what I've been seeing and where I see NFTs and tokenization going.
That was great. As someone once told me an analogy, and it's not original to me, but I love it for this. It's when describing blockchain and decentralized ledgers, it's like someone invented recently the 747, and they haven't figured out how to make it fly yet, but we're offering rides back and forth, up and down the runway and everyone's minds are being blown by that. And what's going on now is a bunch of different companies trying to figure out how to get this thing to lift off in different ways. And some people have gotten their wheels off the ground, others have crashed and burned. But we have this extremely powerful technology that very much can shape the world in a different way. And many people believe it already has. I certainly think that if you look at especially the last 2 years socioeconomic and political events around the world, we've seen the common adoption of tokens and cryptocurrencies in a myriad of ways that economists could never imagine 10 years ago. And we're now seeing the adoption of this technology in new spaces like Paul's talking about with regards to fractionalization of real estate. In a world where we have timeshares and fractionalized ownership of property in other ways, the use of tokenization in a real estate context is something that's being actively explored and put into practice. It's not just a matter of using cryptocurrency to buy something, it's using tokens themselves separate and apart from a currency, but as a token to represent an ownership in a real tangible asset, which is huge. Of course, all these changes, and when the wheels leave the ground, you usually need the FAA to step in and to set some rules on how you should fly and where you should fly. And the government usually fills that role. And so we're fortunate to have Commissioner Weigel here, who is not speaking on behalf of his office, and I'll let him do his disclaimer, to give us an understanding of how this technology is currently being regulated in the state of Florida.
Thank you, Daniel. And I also want to thank the business law section for having us. I need to cloak myself and Paul DeCoste as my law clerk. Our comments are our own. They are not reflective of the Office of Financial Regulation or the state of Florida or any of our cabinet officers or the governor. So purely our own comments and observations. So thank you for this opportunity. Yes, so I can talk about the state of regulation in Florida and nationally and internationally. And you know, one of the unique things that the crypto world brings us as a governmental entity, as a nation, its character is inherently transnational. So being electronic in nature, the participants, as long as they have internet access, they can play in the space of crypto and or engage in some capacity on the blockchain, and that's really by design. I mean, that the blockchain itself is, in essence, a record storage system that is safe from nuclear war. You know, it's stored everywhere, so that you know, if one system, one country goes down, the backup is everywhere. So you know, in that kind of a space, you have, you know, all kinds of people that are participating in commerce, you know, on blockchains. And what do we do to keep bad actors out? And, you know, how do we stop transactions from being illicit in nature? And so different countries and the states have tried to grapple with this, and to date, I would say all unsuccessfully. But there are a couple of you know, broad trends in the works, and in general, the typical government, you know, approach to regulation has started with, you know, what's already on the books, and trying to fit regulation of you know, blockchain opportunities into an established framework. And most often the frameworks that are at issue are the securities regime and the commodities regime. Those are the two most often active players, or active sets of laws that potentially govern aspects of crypto. And at the federal level, this is a daunting task, because the nature of crypto, is any one token, for example, could be an investment opportunity on day one. On day two, it could be widely distributed and be considered more of a commodity, and may have shed some of its investment opportunity characteristics and look more like a currency, for example. And so that presents huge problems in DC, because we have multiple regulators for various aspects of the financial system, and in particular the SEC and the CFTC, that's Securities and Exchange Commission, and Commodities Futures Trading Commission, are the two that are trying to basically jockey for preeminence in the regulatory area. There are others. I mean, there are a number of different agencies that are, active and interested in getting some recognition and turf in this space, and that includes the U.S. Treasury, FinCEN, ultimately even the Federal Reserve, and some other agencies. But so it kind of depends on what you're talking about in the crypto space, to figure out which regulator is going to be most interested in it. And so there's a thing called stable coins, for example, which are coins that are tied or pegged to in our case in the United States, the dollar. And those enterprises tend to look more like depository institutions or financial institutions, and they have the keen interest of the U.S. Treasury, and so that's a focus of regulation. We've had a number of spectacular bankruptcies in the past year with stablecoin enterprises, and with the inevitable cries for the need for regulating these wayward actors and protecting the public. So so that's kind of the backdrop, in essence, at the federal level. I mean, the SEC is, I would say, the most active of all of the federal agencies. Unfortunately, the present state of things seems to be generally regulation by litigation, and there isn't any consistent, or there isn't really any rulemaking specific to virtual currency that I'm aware of at the federal level yet. There has not been any federal legislation passed yet that specifically deals with an aspect of facilitating or regulating blockchain or virtual currency type assets. So I can talk a little bit about what's pending, but that's all to say that there are a couple of other things going on. I mean, internationally, probably the most important development is that the European Union is supposed to come out with a framework for regulating digital assets. So that's one to watch, because if you're playing in this space, the transnational capacity of these digital assets, is going to involve multiple regulations, just like cybersecurity does in a way. I mean, there's different regimes for that, and then different actors, different nations are asserting themselves in different ways, and you just kind of have to know it all and be aware of it, because you might fall into their jurisdiction by engaging in a transaction. So at the state level, I would say probably more than 30 states are engaged in evaluating or trying to pass the industry or the capacity of different enterprises to engage in the industry in their states. Notably, New York was probably the first to lay any kind of framework out. And they're famous for enacting what they call their BIT license, and so they regulate the participants in the industry that are engaging in commerce with New Yorkers. And the New York also has created a so-called green list of digital assets that they consider viable for trading. On the other hand, most of the other states that have done anything are weighing in at some level, probably not as extreme as New York. Just this past week, or in the last 10 days, I think California passed legislation that adopts the Uniform Law Commission's or a variant of it, of the Uniform Law Commission's virtual business license, I think they call it. I forget what the exact name is. I'm not aware yet that it's been signed into law, but I think their legislature has passed it. And that's an interesting development, because the Uniform Law Commission several years ago, created their Uniform Act in this space, and it wasn't really well received. The industry wasn't excited about it, for sure, and to see a state actually go and enact it or try to enact it is very interesting. So because obviously California is going to be a heavy player in this space, but in looking at the act that they passed, it's interesting too, because it doesn't it doesn't seem to be, at least facially, like a very overbearing kind of a treatment for the industry. They're highly interested in that statute in regulating cybersecurity or operational security of the people that are required to be licensed, or I shouldn't say people, the enterprises that are required to be licensed. They're also looking at business continuity, disaster recovery, anti-fraud considerations, anti-money laundering considerations, and anti-terrorist funding activity considerations. And those are going to be the usual kinds of factors that any system is going to be interested in. And it's the first that I've noticed that has really laid them out so blatantly and easily to figure out. So interestingly, they also focused on stable coins as a feature of their specific regulation, and I find that to be interesting and something to watch. And also, they're regulating issuers of certificates or interests in metals, and or particularly precious metals would be of interest. And so there are firms that are based in California that have been issuing like digital gold, they call it, and basically these are blockchain based tokens that are or purport to have investments, or whatever the investment made by an investor is supposed to be invested in actual gold held by the institution that is the issuer, and the investor is being offered a token as a representation of their investment. Well, California is specifically regulating those issuers, and I find that to be very interesting, because it's separate and apart from there doesn't seem to be any other focus on the regulation of a virtual currency or digital asset issuer, other than the stablecoin participants or the metals issuers. So that's kind of cool. Florida just got done. We don't have actually on the or in effect yet, but we have a law that our money transmitter statute now includes virtual currency as a thing that is is going to be regulated effective January 1st in the state of Florida. And that's Florida's only regulatory treatment of anything to do with virtual currency, other than it's also on the books in our money laundering statute in the state. But Florida is highly interested in this space. We are certainly interested in facilitating commerce, particularly in firms that are creating blockchain based solutions for business, for society, and a lot of firms have moved to particularly South Florida or Central Florida to engage in those kinds of activities, and the state is thrilled about it. I think in general. So we of course want to make sure that the landscape is free from fraud, and so the frameworks that are operating in Florida, they're right now, they're just like at the federal level, they're still subject to the securities regime in the state of Florida, and and the anti-fraud considerations that are part of our blue sky statute, and so that's always going to be the case. Whenever in Florida, it's actually broader than at the federal level, because we regulate not only securities, but we regulate investments, and so investments are conceivably a lot broader than just a mere securities issue or issuance, and that can get our agency into complaints about even other things you don't think of as being securities, because they're not, like somebody putting down money as an investment in real estate or something. Anything that's done for investment purposes could come under our state statute. So there is the perhaps antiquated regulatory structure in place that has been in place for decades, but should there be something new to facilitate or limit the direction of growth of this industry in the state of Florida. One of the things that the legislature did this past session is gave my office funding for 3 new people to form a policy unit to facilitate, or actually to guide the legislature in how we should regulate or facilitate the commercialization of this industry. So that's happening as we speak. We're trying to finalize that, but we are approved, and so we're actively trying to prepare policy proposals for the legislature to consider, and we're always happy to and are actually seeking public comment on what they think we ought to be doing in Florida. So we're all ears. This is me saying to you, let us know what you think. Thank you.
And this is something that, thanks, Commissioner. This is something that, to the credit of the state and the Commissioner's office and the legislation in the state of Florida, and it's something that's going on around the country as well, but Florida's been particularly hands-on with practitioners and with the members of the community in the state for the past 4 years. For example, the business law section, to their credit, has had a blockchain and digital assets set of task forces that we've been proactively engaged with the state to discuss what legislation is coming down the pipes, or being discussed, or regulatory ideas are being circulated, and how those might play out, and providing guidance from a hands-on point of view as to how practitioners, lawyers, and people involved in the space would see that shake out. And the state's been extraordinarily receptive to that feedback, and it's allowed for our state to have a very open and robust crypto and tokenization economy as a result, due to that interplay. And it's a credit to that being all ears and remaining open-minded as to the development of this really quickly advancing technology. That said, there is change in the air. In March of 2022, President Biden issued an executive order on digital assets, and as a clarion call to all federal agencies, essentially to say, to the extent you are contemplating this technology, I'd like to hear your thoughts on it. To the extent that you aren't, please start thinking about it. To the extent that you have been thinking about it and have ideas, I'd like to hear what those ideas are and how you actually plan on putting them into use. Some examples of that was the Department of the Treasury for a long time has been exploring this technology since its creation, but more recently has been looking into the idea of a central bank digital currency, which would be a crypto US dollar, which would equate to exactly the same as a fiat cash dollar you'd have in your hand, but it'd be a token, a cryptocurrency, excuse me. And so to the extent they're exploring that, President Biden said, let's shake that out. What would that require? What would you need? Do you think that's a feasible, good idea? And what would the legislation look like that need to be passed to make that happen? So that was in March of 2022. And now we're starting to get the feedback. The agencies are starting to come out with their positions slowly and surely. One example is there's an environmental position that came out saying the shift towards proof of stake, which is a whole separate discussion for a whole separate CLE, but there are different ways that tokens can be authenticated. And a lot of you, I imagine, have seen or read or discussed the negative environmental impact that energy usage associated with tokenization and cryptocurrency has had due to the intense amounts of energy authentication requires. And proof of stake is a far less energy intensive form and means of authenticating tokens and cryptocurrency. And most recently, Ethereum, which is one of the largest blockchains and tokens, shifted to proof of stake. And the federal government from the environmental side said, proof of stake's great, we want more of this. This means that we can have a more sustainable future with this technology where we're now using a fraction of what we were using before. The EU separately is coming out, as the commissioner said, with its market and crypto assets legislation in the very near future. It's called MiCA, which is going to be their guidance as to how they want this stuff to be controlled. And so we have the US federal agencies, which the president does not necessarily dictate how they should handle things, but wants to know their positions and is asking them to speak up. And we have the EU that's coming out with its own legislation within the next, we're talking months, as to how they want to handle this. And so I'm going to open up the floor for the next 6 minutes to see how you guys see this shifting. Do you guys see regulation increasing, and what will be the effect of that in your spaces?
I'll take a hack at it first. You know, from the crypto community perspective, and that's sort of my hat in this, I think you have a lot of dissent against central bank digital currencies. One of the core principles I think you have to understand about crypto prior to, you know, this real institutionalization, right? I mean, in 2017, I couldn't even imagine a group like yourselves would be interested in hearing what we think about crypto. And that's got a lot to do with, you know, a lot of people arrived at Bitcoin and Ethereum because they felt disadvantaged with the US dollar and financial system. And they thought the government was irresponsible with inflation and printing currency and these things. And so that's one of really the core components of, you know, some of the early crypto adopters. And so that, you know, they don't like the fiat dollar any more than why would they like, you know, a central bank digital currency, which, you know, could carry all sorts of other, you know, societal implications, right, about restricting spending or monitoring spending. You know, suffice to say, who knows about the regulations? You guys better than I do. I think that would just be the general tone, though, of how some of the crypto people are reacting to it.
As I mentioned, this is Mike Lingle again. You know, I own crypto, I own NFTs, but I actually, from a business perspective, much prefer to play in the regulated security token space. And Dan, just to pick up on something you said, the IMF actually called yesterday for a global regulatory framework because things are starting to splinter across nations and states. And we're seeing all sort of different frameworks, and we are talking about a global opportunity here. That's part of the promise of blockchain, is being able to transact across nations. I also think the NFTs, crypto is definitely in a gray area. The NFTs have created a gray area where people are trying to accomplish with NFTs things that are securities. And again, the SEC has come out and specifically said they're looking at fractionalization of NFTs. And if we go back to the Howey test, right, if we have multiple owners of an asset expecting to profit, right, we've stepped into Howey test territory and we've created securities. So when we talk about tokenizing real estate, fractionalizing ownership of real estate, those kind of things, I'm talking to a group of lawyers here. I highly recommend staying on the side of the law, and there are frameworks to do that. I just posted an answer to the Q&A with some links to people who are tokenizing and fractionalizing real estate ownership in compliance with securities laws. Definitely a lot of this is being done under the Jobs Act. So you take an exemption from the Jobs Act, you raise money using that exemption, you follow the rules, and then you tokenize the resulting entity that is created. My favorite, and what we do at Security Token Group, is really focus on following the rules ourselves and helping other companies figure out how to follow the rules as they tokenize these assets and these projects, so that you don't end up, right? Because all the SEC and other government enforcement is retroactive, right? They will come and punish you for things you did in the past, right? So if you start off compliant, there is much less of a chance that they will one day decide that your fractionalized NFT is illegal and come back and ask you to solve that problem.
Can I add something briefly to the NFT conversation?
Sure.
So I think, using your analogy, that 747 going down the tarmac, that's really the phase of NFTs we're in right now. It's really about profit, right? There's no way around it. You're buying these tokens with the expectation to sell them for a greater price. As all industries do, we're going through this, sort of growing up phase, and there's a lot of interesting components about NFTs that leverage the immutable database portion of a blockchain that have very little to do with financialization or seeking profit. So one just short example is credentialing. We've all used LinkedIn, we've all have degrees or accolades, accomplishments, even ticketing, if you want to consider that. That's something that can be used or can use an immutable database actually for cheaper than existing databases and arguably more secure. It has nothing to do with seeking profit, but it's an instrument that can be an NFT. And just last point on that, we have an even greater innovation on top of that recently called soulbound tokens. And soulbound tokens, NFTs, are once issued and transferred to that wallet, they can never actually leave. And so, there you go, there's your answer. You're never expecting profit from those. What they're supposed to do is represent something like a degree or something that someone earned and therefore should not be able to just give to someone. Just one point on NFTs that I find exciting.
It's great. Thank you for explaining that. And I think that one thing that's very tempting for anyone looking at this space is a desire to label and group and put things into silos. Mm-hmm. And the government and practitioners struggle with that because, on the one hand, we already have this existing set of rules that do apply to many aspects of this technology, as Mike has explained, as Thomas has explained, as the commission has explained, as Paul's explained. And that's why it is important, and I'm going to plug lawyers on this one, to reach out to counsel and make sure that if you are getting involved in this space, to make sure that you are checking your boxes and doing it right, because the SEC is litigating these issues. And if you do create a business that's based on an NFT and you aren't doing the diligence to ensure that what you're offering is or is not a security, you might have trouble being able to litigate issues that come out of that due to lack of or different compliance with existing laws. That said, the government, I think the trend is leading towards trying to clarify who has oversight over more specific things. And there is going to be more of an attempt to silo things under the SEC or the CFTC. And there are going to be conflicts, as Mike pointed out, with other international regulatory attempts to do the same. And we're dealing with big markets and world players in China, in Russia, in the EU, the US, and in South America that are all vying for an influential role in how we view and leverage this technology. And more than anything, I think all those attempts will work to help legitimize legitimate products. And there is a common goal to weed out illegitimate products and to build more universal trust in this technology that has shown itself to have staying power. And so a big lasting message of the past several years is through the trials and tribulations of everything that's gone on, crypto has prevailed for better or for worse. And we've seen it as something that has stuck around with regards to sanctions. And we've also seen it to help buoy nations in need of financial assistance. And we've also seen it used in incredible new transactional and artistic spaces like the NFT stuff that we've seen throughout the news recently. With that said, we've got 4 more minutes. And so it's very simple. We got a handful of questions. I'm going to try and hit some of them and then open up the floor for a couple of them. All right. One, we do not have a PowerPoint for this presentation, but future portions of the series will have PowerPoints, and those will always be circulated and made available when they're created. For those asking about the proposed UCC Article 12 and how it will affect their businesses, the business law section has a task force specifically set up to analyze UCC Article 12. I highly recommend checking that out. Robert Kane is the chair of it. And there's meetings going on very regularly to discuss UCC Article 12 and its role. And to the extent that anyone here wants to discuss that, we could get to that in a second. Since the SEC and CFTC are about 5 years behind, does it make sense to reach out to SEC, CFTC counsel? Yes, absolutely. These matters are being litigated, and the SEC has done a really good job of trying to hold parties accountable across the country, for better or for worse, with success or not. There's a question to the commissioner and Paul. Since there's an enormous explosion of NFTs and NFT trading, fractionalization, and derivatives, is the business risk regarding SEC, CFTC enforcement low, given the defense that everyone is doing this and there are no clear guidelines? I can't be that guilty. Or is there a historical basis for there being a risk analysis with regards to the Howey test and SEC enforcement? I think the answer to that was yes, there's a historical precedent for these things being prosecuted and there is a risk.
Absolutely right, yes.
Isn't there some point where you can cash out to a non-virtual currency, deposit to federally insured bank account or actual cash? If that is the case, how is that not a promise to pay? Evokes the UCC or even Florida's documentary stamps regulatory overlay.
I can take a small step at that. Not speaking to Florida, generally, any of these off ramps, as you know, they're defined in crypto, meaning from virtual currency into a bank or custodian account. Those are separate from the actual protocols that may issue the currencies. So the most popular one in the States being Coinbase. That's a fiat on and off ramp that allows you to sell tokens and then eventually end up with a non-virtual currency. And they're regulated on their own.
And the UCC task force is actively exploring that as well. For those who've attended, thank you for attending. This is the first and will be a series. We hope to see you at the next series. The CLE number, importantly, everyone take out your pencils, take out your note app, is 6078. 6078. I'm putting that in the chat. And we will get to the next question. If a person owns an NFT of a tangible asset, like a basketball card, does an owner of the NFT ever hold the tangible asset?
Sometimes. And actually what we've seen specific with sports card trading is there are digital only options such as NBA Top Shot, where it's literally just a digital asset. But we're also starting to see real sports cards. So you send your sports card into a vault, the sports card is held in a vault, and then you trade ownership of the sports card as an NFT. So the asset exists, but the asset isn't moving around, the asset is protected. Ownership is moving around using a tokenized NFT.
There's even been cases of people destroying physicals which doesn't quite make sense, but that's something people do.
Thank you to our panelists for taking part in this first presentation of the series. Everyone is accessible and can be found online. You're welcome to Google us and reach out to us if you have further questions. Remember, if you know somebody might benefit from this, they can find this video on the Business Law Section's YouTube channel. Again, the CLE number is 6078. That's the course number. You can enter that online to get your credits. And if you're watching the CLE on YouTube, that's good for 18 months from when this is published. So you got time to do it.
Someone is saying 6078 does not exist.
Well, that's a fun thing. We'll see what the Florida Bar says, and we'll circulate something to every single person. You all have your own individual signups. So we will circulate an email to ensure that everyone gets credit. That was the number that I was provided, and we'll make sure that that is reconciled. Thank you all. We look forward to seeing you at the next installation of this series. Take care.
Take care.